Understanding debt financing for small businesses in most detailed. Finding the financing to expand your operations is one of the big problems you face as a small business owner. Small companies frequently use debt financing for small businesses to get the money they need to invest in their operations. Debt financing requires borrowing loans that must be repaid over time and with interest. Debt financing for small businesses is available from a number of institutions, including conventional banks, credit unions, and private lenders. What is debt financing for small businesses? Debt finance is the term for borrowing cash for your company. You must repay the money you borrow, frequently with interest. Depending on the sort of debt financing involved, you may have a defined time schedule for repaying what you borrow. Debt financing for small businesses can take many various forms, including a term loan, loans from the Small Business Administration, peer-to-peer financing, business credit lines, commercial credit cards, business cash advances, invoice financing or factoring, inventory borrowing. Loans for equipment. Debt finance also includes any personal loans taken out for business purposes from a bank, credit union, online lender, or close friends and family. Based on its objective and the gap it fills for small firms, debt financing can be distinguished. Invoice loans and merchant cash advances are two examples of short-term debt finance. Companies take out a fixed loan amount, which is subsequently repaid over a number of months as opposed to years. This kind of borrowing is typically suitable for bridging brief cash flow shortages to pay for working capital costs. On the other hand, a loan for equipment would normally be paid back over time. This kind of loan is intended to assist firms in investing in long-term growth objectives rather than being utilized to finance immediate requirements. How debt financing for small businesses works. A cash flow loan, revolving loan, or installment loan are three different ways to structure debt financing. Installment loan. You borrow money up front from a lender and pay it back with interest over a predetermined time period. These loans, often known as conventional term loans, can be secured or unsecured. Revolving loan. You have access to a predetermined credit line that you are free to use as you see fit. Once you've paid back the money you've borrowed, your credit line resets, and you only pay interest on the cash you actually spend. A revolving loan is an example of which are credit card, cash flow loan, a cash flow loan, revolving loan, or installment loan are three different ways to structure debt financing. Based on your company's revenue, you get a cash advance. While some lenders may look at the information in your business bank account, others may look at your recent cash flow and make loans based on prospective sales. Cash flow loans include both merchant cash advances and invoice factoring. Depending on a number of variables, including how you intend to use your cash, the type of loan you're searching for, and the length of time you'd like to have to repay your debt, you can select between short-term and long-term debt financing. Short-term debt financing. The normal payback time for short-term debt financing for small businesses is 12 months or fewer, though standard terms might vary from lender to lender. Short-term funding options like credit cards and commercial lines of credit are common. This kind of financing is frequently utilized to pay for your company's ongoing running costs. Short-term debt financing might be used for working capital, inventory purchases, or payroll. Long-term debt financing repayment periods for long-term debt financing for small businesses typically range from 10 years to 25 years. Bank loans and SBA loans are typical types. Long-term financing is utilized for bigger investments and projects like buying equipment, remodeling a firm, buying an existing business, or building a new location. Types of debt financing for small businesses. Business term loans. One of the common forms of debt financing for small businesses, business term loans function similarly to a vehicle loan or mortgage. With a term loan, you obtain an upfront lump sum of funds for a certain use. Over a predetermined length of time, you make fixed, equal payments on the loan, plus interest. Term loans are ideal for certain use cases like business expansions or upgrades. Certain loans, like those for equipment finance or commercial real estate, are made to make certain business acquisitions easier. SBA loans. SBA loans are small business loans granted by participating lenders, mainly banks and credit unions, and partially guaranteed by the U.S. Small Business Administration. Lenders are exposed to less risk as a result of the partial government guarantee, which encourages them to deal with small enterprises.
SBA loans come in a variety of forms, but they are often set up as term loans. Regarding maximum loan amounts, repayment terms, and interest rates, the SBA issues regulations for lenders. For a number of things, such as working capital requirements, business growth, and equipment acquisitions, SBA loans can be a suitable alternative. Business lines of credit. You have access to a predetermined amount of money through a company line of credit, which you can use as you need it. Once you have paid back the money you have borrowed, the credit line often resets to its initial level, and you only pay interest on the funds you actually withdraw. One of the most adaptable types of debt financing are business lines of credit, which may be used to manage cash flow gaps and pay for operational costs like buying staff or buying merchandise. Invoice financing and invoice factoring. You can get funds using your unpaid invoice through both invoice factoring and invoice financing. While invoice factoring refers to selling your invoice to a factoring company at a discount. Invoice financing entails borrowing money from a lender, in the form of a loan or line of credit, on your unpaid invoice. Although there are some distinctions between these two debt financing options, both are suitable for business-to-business firms that experience cash flow problems as a result of unpaid customer invoice. Merchant cash advance. Visa. Merchant cash advance, also known as an MCA. A business provides you an upfront lump sum of money that you pay back with a portion of your